This week I'm sharing my 9 favorite price action strategies that I have learned over the last 15 years being mostly a price action trader. I'll focus also a lot of entries, so we'll also take a look at where's the optimal entry, where are secondary entries, and we're going to take a deep dive into a lot of different and interesting price action concepts. I've prepared a variety of different price action setups and studies, so let's take a look at the first very simple one. Very often we're going to see a chart that looks similar to this. We are in a downtrend, and then a lot of traders are seeing this pattern that some people may call maybe a distribution. You'll see that we have made higher lows, and this all indicates towards more bullishness to come as the bears are leaving. The sellers are not as strong anymore. Maybe a lot of sellers have also taken profits as the trade has and the trend has unfolded. So a lot of people are going to go long here, right? And I don't think there's any particularly wrong with that, but it's always interesting and it's always very valuable to ask yourself, where will the other traders have their stop loss? So getting into a buyout or breakout trade here, you will have your stop loss probably somewhere in here. And as the trend progresses and as you sit on a little bit more profits, most traders will move their stop loss to break even. So it will be somewhere around here. And I have said it many times in the past that break even stops should be avoided. They don't work, and even worse, they will kick you out of the trades, because at this point it is just so clear that everybody will have their stop loss here. Everybody will be in a breakout long, and then inevitably this happens, right? It's a failed breakout, it's a stop run, and this is very common. You can see the price really accelerates into the stop area because it's just so clear everybody will have their stop loss here. So if you're trading breakouts, you have to be generous with your stop loss, and also don't move your stop loss too soon. Wait for the first stop run, or altogether turn it into a secondary signal. Wait for the squeeze to happen. After the market ran into the stop area, wait for the momentum to kick back in. And if you see that strong buying is resuming and coming back into the market, this could be your squeeze entry. So another secondary, or if you don't take the first breakout and only focus on those types of squeezes, this could be your initial entry. In this case, it's not as likely to see another stop run. So your stop loss can be somewhere around here at the bottom, and you don't have to put it all the way down. And then you could use a 2-to-1, 3-to-1, 4-to-1 reward to risk ratio. And those things happen quite often. I have a few other ones that use similar concepts, but in a different context. So that will be quite interesting. What do we see here? Does it look bullish? Does it look bearish? Let's analyze it and let's get into it. So the first very important clue that we have is that we have a momentum divergence, which means that the price in this area made higher highs. So you can see from here to here and here, the price did make higher highs. So technically it's a bullish continuation. But if we apply, for example, the RSI, you can also use the MACD or the stochastic. You will see that this is actually a divergence, as the RSI made lower highs. So the price action and the indicator are not agreeing. They're showing opposite signals. This means the RSI is picking up clues that the chart doesn't show you at first glance. So the uptrend here, the pushes into new highs are very weak. There's not a lot of bullish pressure here, and that's what the RSI confirms and really shows you. So this shows you that be a little bit more cautious. If you are in a long trade, consider taking profits, or at least partial profits, because the likelihood of a continuation to the upside is not as high. What we also see is that we have a completed Fibonacci sequence. When we apply the Fibonacci from point A here to drag it to point B here, then we see we have a perfect retracement, whether it's 38 or 61, doesn't matter. It's a perfect retracement, and then you can see the first move goes into 161.8. That's the regular Fib move, 38, 161. Then you can see we have a little bit of a retracement. We don't fall back below 100, which is good because it makes the likelihood of seeing a completion to the 200 bonus round a little bit more likely. But after we hit the 200, it's very unlikely at this point to see more of a continuation. Especially now in the context of the divergence, it really shows us that what you could have expected from the trend is already or has already happened. And at this point, if the price reaches 200, it's more likely to see the profit taking happening of the bulls, and then probably a reversal. What we can do is now wait for deceleration. So what we have is here, first we see the market is accelerating. We have strong candles, but then suddenly the momentum is dying down. You can see we have a doji, and then 1, 2, 3, 4, 5 bearish candles. So the market is pausing, which it never did here when you look left. Every time the market made a new high, we either saw a pullback or directly a continuation afterwards. But this is very different. We see a deceleration, a prolonged deceleration, and then suddenly we see acceleration, but acceleration into the bearish side. So this could be a very aggressive entry. Stops are generally then placed above the highs here, not too close because it's very common to see stop runs into the highs. So be generous with your stop, but it's a very aggressive entry. You could also wait for the market to break a structure, which is here in this case. We have a previous support level that was tested twice, and then we fall back below it, retest it as resistance. We have a flag pattern here, so a great break and retest entry could be here, and then you can just have your pending order maybe below the lows, or if you are more aggressive, wait for the bearish candle to close. You see that there is bearish momentum kicking in, and that could be a secondary entry. Stop loss again above here. Never put the stop loss too close. You're going to suffocate your trade. Give it some room to breathe so that you're not victim to stop runs as easily. And then you can see afterwards that happens. Again, don't move your stop loss to break even too soon, because you will see very often the price will come back into the stop zone. If you get in on the breakout here, people will move their stop loss to break even when the market moves a little bit in their favor, and the break even stops are right here where the market dipped back in. So again, stop placement, stop movement is something that is often overlooked. It's a very important concept though. Now we're seeing a different type of scenario, and what we are seeing here is a failed high continuation. We have a double top here in a very strong uptrend. You can see we made several trend waves, 1, 2, 3, 4, 5, and then here we are probably in wave 6. So the Elliott wave count has been completed, and we are seeing here lower highs. When the market is failing to make lower highs, that's a very, very strong bearish signal. However, this is not enough to get into a trade yet. We have to wait for some type of break into a new low. So we have a previous support level that was initiated here. We have a second confirmation here. Then we have a break here. Also, what I find is very important is we have the broken pivot structure. If there's one tool that I would recommend to any trader, no matter what trading style you use, it's using the central pivot point. In TradingView, you can just search for standard pivot, and then you can use the daily pivot point if you are a day trader, or the weekly pivot point if you are a little bit more on the higher time frames. That's the blue line here. And what happens is that in an uptrend, the market trades above the pivot point. But if you see that the price is breaking below a central pivot point like it did here, and also it's happening in the context of lower highs, and also the break into a lower low, that's a very big bearish signal. It's a very strong, important bearish signal. So this could be the starting point for first aggressive short entries once you see that something like that is coming together. It's important that you have actually a breakout through a market structure and also here the bearish context. And you can see afterwards the pivot points on the way down provide secondary or later entries. You can see the market is coming back into a pivot point, retesting it as resistance and selling off. Coming back into the pivot point, retesting it as resistance and selling off. So the pivot point structure is very important. I will come back to this in this video 1 or 2 more times because it's one of the most important things that any price action trader or indicator trader can use. I would really suggest you try it out, put it on your charts and see how well it behaves, especially during trending markets. It's a very great tool to have. What can we see on this chart? What are some bullish, what are some bearish clues? Let's dig into it and do some price analysis. First of all, we can see we have a flat top triangle. You can see we have a flat resistance level. And then if we put a trend line here, you can see it's sloping up. So a flat top triangle, it's neither bullish or bearish. It's more of a neutral pattern because it could lead to a continuation breakout or also a reversal breakout if we exit the triangle. So it's a neutral pattern, but it's a good starting point for your analysis because it helps you start creating trading plans. We also have a fake out, so the market actually did try to break out here but was rejected. That's an important market tell as well. So here on the lower time frame, we can nicely draw the pattern, we connect the lows to get the flat top triangle pattern. And then we can start building trading plans. We could say, okay, we're going to trade a breakout to the upside if we get actually close above the highs. That could be a long entry. Or we wait for a breakout here below the lows, and that is initiation then for a short entry. You can see we have a break and retest pattern, and that could be now your first short entry here. We move below the support level here, we come back into the trend line, retest the trend line, and then the next candle is almost an engulfing candle, so very strong bearish signal, so that could be your retest entry. Stop placement is always a little bit personal. Some traders like to be a little bit more aggressive, some traders like to play it safe, and you could either have your stop loss right above here inside the pattern at the trend line. However, you are more susceptible to stop runs. If you see that you are a victim of stop runs and you're often taking out on your trades too early and the price afterwards goes back to your target, then maybe your stop loss is a little bit too aggressive. You could add a little bit more space to your stop loss, put it all the way above here. I don't necessarily see a reason why you should put it all the way above the highs. That's usually a little bit too far and you are reducing your reward to risk ratio unnecessarily. So it's a little bit personal, but if you see that you are a victim of stop runs, give it a little bit more room. If on the other hand you see that the price is never even able to come close to your stop loss, then maybe reduce the size step by step, gradually, not too much at once, and that could help you with your reward to risk ratio as well. And then you can see afterwards the market resumed to the downside. You could again use pivot points. I'm pretty sure we have one or the other pivot point retest here on the way down. This example is quite simple, but you will see it quite often as well. That's why I included it. So we are in a very strong uptrend. You can see I added the EMA 50 period. That's the blue line. And what you see is that the market is trading above the moving average all the way. We have never seen a violation and the market never crossed below the moving average, which is a very good bullish sign. And then you can see here we are, again, you could say maybe a flat top triangle. And whereas previously we have talked about a flat top triangle in a reversal setup, let's look at a continuation. What we see is that the market pushed into the moving average twice here, first time here, second time here. The moving average was rejected every time. So that is also a bullish signal. Then you can see we are seeing the market pushing back into the resistance level. Those lower bounces are pressure patterns, so there's a lot of pressure building up here below the resistance level. Every time the market is coming into the level sooner and not able to move as low as previously. So that is showing us there's a lot of pressure building up. And on the breakout, never in the pattern, on the breakout, you could think about getting into long trades. I would always discourage you from trading inside patterns. That's a very low probability trading strategy. You will usually run into fake outs and have very bad outcomes. So never in a pattern, always wait for the market to pick a direction, wait for the breakout, wait for the break and retest, or wait for the fake out as well. Those can be all much better signals than trading in a pattern. And you can see we have the breakout and then the continuation. So very classic. In such a case, typically the stop loss is trailed around the 50 EMA. Or if you want to be a little bit more aggressive, you could add for stop trailing a 20 period, which also works very nicely. And you're able to catch those impulsive trends and trail your stop loss much quicker with a short-term EMA. So 20 works really well. 12 is a little bit too low, but 20 is generally a good middle way. Let's build another price action case, and we're starting here with a higher time frame. You can see the price was in a very strong downtrend, and then here recently the price is in a range pattern. We could also call it a flag. At this point, it's obviously impossible to say, will there be a long breakout and we're going to move higher, or will we continue on the way down? So we have to build a case step by step, and we have to look for confluence. First of all, we can add the pivot point. This is a pivot point, a bearish pivot point structure. You can see we're trading below the weekly pivot point here. We broke below it, rejected it as active resistance, and then now we're doing the same. This is a very bearish signal. And as long as the market is trading below such a central pivot point, I would always be more on the bearish side. I would not automatically go short yet. I would start building a trading plan. But being below the pivot point is a very bearish signal. If the market gets above the pivot point, that would completely change everything and I would turn bullish. But for now, nothing points to that and we have to resume bearish. And you can see we have a break and retest entry. Again, we have Very often break and retest come together. Sometimes you will only have a breakout without a retest. So we never know in advance if there will be a retest. And if you choose to be a retest trader, you just have to be okay with sometimes missing a move if there is no retest happening. So we have the breakout here, we have the retest here, we are moving back into the previous lows, we are retesting the trend line very actively, and then you can see this is now the momentum push away. How you enter that, you could wait for a complete candle close, or some traders prefer to use a pending order below the lows. Trading right at the level here is a little bit too risky. What you could do is drop to a lower time frame. After you see that the breakout has happened, you drop to a lower time frame, maybe the 15-minute, maybe the 5-minute, and then you look for patterns around the trend line here that could help you get into a bearish trade. And then you can see the bearish pivot point structure remains. We're trading below it, and the bearish continuation is going on. Now we're having a price action news-driven volatility pattern, and especially if you trade the lower time frames, this is the 50-minute, news have to be factored into your trading plans. And there was a news event coming out here. And what you see is that we are first having an initial breakout, then we move lower, then we move higher, and then we move lower again. So we're changing the direction multiple times. And this is very common during news. It's especially common if news happen when a price is at a very important resistance or support level. What I would recommend on the lower time frames, to avoid the risk, close all your trades if you're in a trade before the news is released. And after the news has been released, wait for at least 1 or 2 spikes and wait for maybe 15-minute, maybe 30-minute, depending on the impact level of the news event before you even think about getting into a trade. Very often you will see that after 10, 15, 20 minutes, the market is back to normal, and then the picture looks much clearer. So now what we have a pivot point structure. We are also trading here below the low. So you can see here's a support level that we faked out during the news once, then we moved higher. We have to fake out here, and then we move lower. At this point, it's a very clear sell. Why? You can see we have our broken support level, we have our fake out, we have the broken pivot structure. And all of those things are pointing towards bearishness. Lots of people have been trapped here. The long breakout traders, probably, if you go in long here, where's your stop loss? Somewhere between the resistance and probably here below the lows. That is why you see an acceleration in selling going on. Think about it. You're long and your stop loss is here, and down here are all the stops. Stops on a long position are essentially short orders. So as more shorts are getting triggered, more shorts are being initiated, more people are becoming sellers, and they're driving the price down. So this is accelerating around those stop clusters. That's why you will often see that around stop clusters, the momentum is picking up and you suddenly see huge candles. And that is the case here, and afterwards a continuation below the previous lows. However, the most important takeaway is here really that before and after news, wait a little bit for the dust to settle, and then usually the picture looks much clearer. This is a very interesting chart study because it shows us 2 patterns right after each other, which is very common to see. And a lot of traders are feeling probably confused when dealing with such a setup. So what we see, first of all, we have an inverse head and shoulders here that played out. You have your left shoulder, the head, the right shoulder. You have a very clear neckline, you have your breakout, and the market moves higher. So the inverse head and shoulder did work out. And now suddenly you have a regular head and shoulders pattern, which is a bearish signal. You have your left shoulder, the head, and the right shoulder is currently building. So what do you do in such a case? Is the inverse head and shoulder still active, or is the head and shoulders now active, the bearish signal? And what I have found in my trading is that always pay more attention to what is happening most recently on the right-hand side. It is way more important what is currently happening than what has happened in the past. So the inverse head and shoulders, I would not put any emphasis anymore on it because it has, first of all, played out. There was a breakout and we moved higher. Second of all, it is past, it is history, it is not active anymore because now this is showing us the current state of the market. What is it showing us? It showed us that we had a resistance, we pushed higher, and you can see suddenly a lot of selling is coming in. We have a lot of bearish candles, 1, 2, 3, 4 candles, very strong candles, which we have not seen here anyway in most recent price history. So that's a very strong signal. And then we have our right shoulder currently building. This is the right shoulder breakout. So this is where now people are getting short. And at this point, I would not worry at all anymore about what has happened with the inverse head and shoulders. This has been done. It is not important anymore. But the regular head and shoulders, the bearish head and shoulders is now taking over. We have significantly lower highs. On a breakout, usually your stop loss goes somewhere around the vicinity of the right shoulder. Typically, it's way too far away to put it around the head, but somewhere around here is usually where you have stops around the head and shoulder. What we have here is a retest pattern. So again, what happens? The traders getting in on the breakout here. The market moves a little bit in their favor. Everybody's getting scared. They're putting their stop loss way closer. And then you have stop runs. You have stop runs in the breakout area. And also I activated the pivot. And you will see, if you start paying attention to the pivot, how well respected it is across all the time frames, across all the markets, and especially for breakouts, for trending markets, for re-entry opportunities. It's an invaluable tool that is free on all trading platforms, and it's just so valuable. I would always recommend that you take a look at it and see how you can implement it. And here you have now your break and retest entry. You are exiting out of the flag pattern after the breakout out of the head and shoulders. And then afterwards you can see this is where the trend unfolded. So very interesting case study. And I think we learned one or two things here looking at this as well. Let's look at a ranging market and let's see what we can learn here. So we have a long-term range. We have the upper resistance of the range here. We have the lower range of the resistance here. What we see right now, are we looking at a potential breakout? We have a lot of bullish momentum coming in, or is this going to turn into a fake out? The most important lesson that we have to learn in such a context is that we don't know. We don't know until we have clear signals. And many traders want to always predict what is going to happen next, but that's not how trading works. Trading is about anticipating. And as a trader, we have to build a case for our trade. So we have to collect clues for what is speaking for a long breakout, what is speaking for a short reversal. So let's dig into it. Now when we see on the lower time frame, what do we have here? This is the upper resistance that we have here. On the lower time frame, this is what it looks like. It looks like we have a failed breakout. We have an exhaustion pattern. We had strong momentum coming into the market. We have lower highs. And we have strong selling coming in. The selling is here really the interesting thing, because look at it. We suddenly have strong bearish candles that we have not seen in the past. And we have lower highs. The market did try to break this level twice, but was rejected. So this is speaking very much for bearishness. It's not enough. I would never go short just yet, but the scale is tipping a little bit more towards more bearishness. What we can see now, just a few candles later, is we're having a head and shoulder continuation. Left shoulder, head, right shoulder. We have here the neckline, and we are seeing a lot of strong bearish momentum. This would be an aggressive short entry. And you could wait for the big support cluster here to break as well. Here's our pivot point. So getting in above the pivot point is a little bit more risky, because this could turn into a support and we could see a bounce higher. So you have to understand that if you take risky entries, sometimes you will get rewarded and you will get a higher reward to risk ratio because you are earlier in the trade, but your win rate will also suffer because sometimes those levels will hold and you'll shoot up higher. Now it looks very different. Now we have our break and retest structure that we have seen so many times, and it's a pattern that you can really nicely add to a lot of different breakout strategies. We have our head and shoulder breakout, we have our head and shoulder pattern here, the trend line. We break out, retest it, and immediately reverse. The immediate reversal is here what is selling me on this breakout. At this point, it looks very bearish. I would still put my stop loss somewhere around here. There's no point in putting it anywhere closer and here below the trend line. It would be too vulnerable. So the stop loss has to be protected, and the break and retest, especially in this context, we are trading at the outer edges of the big range. We have the failed breakout, we have the head and shoulders, we have the breakout and retest pattern. And you can see afterwards this is what happens. So we don't know in advance this turns into a breakout or a fake out. We have to slowly build our case, and we have to wait patiently for all the puzzles to fall into place. And I hope you learned something in the video. I hope the different scenarios and studies helped you find some new price action principles or strategies. If so, let me know in the comments below, and then you will hear from me in my next video.